Nico Mitchell started a new business, Nico Solutions, that completed the following transactions during its first year in operations. Now I'm only going to read transactions A and B on this slide. Nico Mitchell invests $70,000 cash in office equipment valued at $10,000 in the business. Nico then purchased a $150,000 building to use as an office. The company paid $20,000 in cash and signed a note payable promising to pay the $130,000 balance over the next 10 years. Now, sliding down to the requirements, Requirement 1 says, using headings for the various accounts, but using just one for revenues and another for expenses, use additions and subtractions to show the effects of these transactions on individual items of the accounting equation. Show new balances after each transaction. And Part 2 says determine the company's net income. Okay, let's take a look at transactions A and B. First, the investment of $70,000. And you see on the bottom of the screen here, cash is increased by $70,000 since we're increasing cash, investing it in the business. And the office equipment valued at $10,000 also increases. And the offset over on the equity side of the accounting equation is an increase of $80,000, equal to the cash investment and the $10,000 increase in office equipment. Then on transaction B, we purchased a $150,000 building to use as an office. So building increases by $150,000. We also increase our liabilities under notes payable to show that we have an obligation to pay back the $130,000 note or loan payable that we used to buy the building, and that increases by $130,000. And we paid a $20,000, it looks like down payment when we signed the note, so that decreases our cash by $20,000, and as a result, assets increase by $130,000, the $150,000 less the $20,000 of cash, and liabilities also increase by $130,000. Therefore, that transaction is in balance, and when we run our balance at this point, we see that it looks like we've got $50,000 in cash, $10,000 in office equipment, and $150,000 in buildings. So that looks like, what, $210,000? And we've got $210,000 over on the liabilities plus equity side, so we're in balance. Next, we take a look at transactions C and D. On C, we purchased office equipment for $15,000 in cash, and then on D, we purchased $1,200 of office supplies and $1,700 of office equipment on credit. Okay, now on the bottom of the screen, you see how these transactions are handled. The $15,000 of cash that we spend on office equipment reduces our cash balance, and office equipment increases by $15,000. So the net effect is that there's no change on assets from transactions C. There's no change in total. Then in transaction D says we purchased $1,200 of office supplies, so we see the $1,200 increase, and we see $1,700 of office equipment increase on credit. So now we've got a $1,700 increase on office equipment. Both of those were purchased on credit, which means somebody allowed us to take possession of the office supplies and the office equipment today in exchange for a promise that we will pay for the supplies and the equipment at some point in the future. So as a result, we've created a new obligation that shows up under accounts payable to show the increase in our liabilities, the obligation to pay the vendor or vendors for the office supplies and office equipment. Next, we take a look at transaction E and F. E says that we paid a local newspaper $500 cash for printing an announcement of the office's opening, and F says we completed a financial plan for a client and billed that client $2,800 for the service. Okay, now you see how these transactions are handled on the bottom part of your screen. We used $500 cash for printing the announcement, so cash is reduced by $500. That represents an expense. It represents effort made in the hopes of generating revenues. So we see expenses increase over on the equity side. Now, because expenses actually increase And the accounting equation says begin with capital, subtract withdrawals, increase revenues, and subtract expenses. We show this one as a negative amount. Therefore, our accounting transaction, a decrease in assets and a decrease in equity, is still in balance. Then on transaction F, we complete some revenues and we bill the client, meaning that we didn't receive cash for it now, but we expect to be paid in the future. So we increase accounts receivable, which is an asset. It represents future economic value to the business, and we also record the revenues under the equity side. So again, assets increase, equities increase, and the accounting equation remains in balance. Transaction G says, designed a financial plan for another client and immediately collected a $4,000 cash fee. H says, Mitchell withdrew $3,275 cash for personal use. Okay, now if you look to the bottom of the slide, you see how these transactions are handled. For transaction G, the immediate cash receipt increases cash for $4,000, which increases our assets. And we record the revenues since we completed the service by completing the financial plan for the client. Therefore, the assets increase by $4,000 and equity increases, and we're still in balance. Then on the next transaction, the owner withdrew $3,275 cash for personal use. So we see cash decreases by $3,275, and we enter a positive amount, actually a negative amount, under Mitchell withdrawals, $3,275. It shows up negative because of the equity equation that begins with capital and then subtracts withdrawal, adds revenues, and subtracts expenses. So as a result, cash decreases and so does equity, and we're still in balance. On transaction I, the company received $1,800 cash from the client described in transaction F. And on transaction J, the company made a $700 cash payment on the equipment purchased in transaction D. Okay, now looking down below on this slide, you can see the $1,800 cash receipt showing an increase in cash and a decrease in accounts receivable because the customer has paid the money that was owed. And then on transaction J, you see $700 cash being reduced and accounts payable also being reduced. Both of these transactions, we remain in balance. On transaction I, the assets in total do not change because cash increases and accounts receivable decrease, and both are asset accounts, while on transaction J, assets decrease by $700 since cash decreases, but our obligations also decrease. Accounts payable decreases by $700, and therefore the accounting equation is still in balance. The last transaction says that we paid the office secretary's salaries of $1,800. So if you look to the bottom of the image you see here on this slide, you see that for transaction K, cash is decreased by $1,800 and expenses are also decreased. Now, remember that expenses really are increased, but the way we show the equity formula of capital less withdrawals plus revenues minus expenses, we see that expenses show up as a decrease to equity, and it's for that reason that the accounting transaction stays in balance. Assets have decreased by $1,800 and expenses have decreased by $1,800. Now also on this slide, you see all of the transactions in their entirety and the running balance. And when we're all done, if you add up the assets and then add up the liabilities and equity, you will see that we're in balance. The last requirement on this problem asks us to compute Nico's Solutions net income. And if you look to the bottom of the slide, you see the calculation. There was total revenues of $6,800 and total expenses of $2,300. So when we subtract the expenses from the revenues, we see that Nico's Solutions net income equaled $4,500.